Hello and welcome to CNBC-TV18's Mumbai Newsroom. I'm Sumaira Abdi and you're watching MF Corner. Joining us today, we have Joydeep Sen, who's a corporate trainer and author, and he's going to talk about what's really going on with debt funds these days. You know, returns have been muted. What is the outlook? Should investors be considering it now? Or is there still status quo with regards to your fixed income investment? So we'll ask him all of those questions. Joydeep, thanks very much for joining in. So first, I want to ask you the broad trends. What are you picking up in terms of, what's the latest with debt funds?
Hi, Sumaira, and greetings to all the viewers. So yes, I'll talk of three broad aspects to start with. One is the AUM, which is the money under management or assets under management. Then the performance, which you said is muted. And thirdly, the portfolio quality. Now, starting with AUM or the assets under management, to give you a bit of history, starting with say March of 2020, like 2.5 years ago, the AUM was rupees 11.5 lakh crores, it is rupees 11.5 trillion. So March 2020 was 13.8 trillion, a little higher. March 22, they said was similar, 13.8 trillion rupees. But now in July, it dipped a bit to around 13.3 lakh crores. So why so? What happened? So this thing that happened is subsequent to RBI rate hikes, the bank deposit rates are increasing. So investors have another alternative, somewhat better rates than earlier. And secondly, as you said, the returns have been muted. So that has been impacting investor sentiments. So these two reasons combined, yes, there's a bit of a drag on asset under management, but yes, gradually things will pick up. The data I gave you was for the usual debt funds, apart from FMPs and target maturity funds. Now talking of performance, as we said, it has been muted. To give you some numbers, I'm giving you the category average, that is the average of schemes in that category. Over the last 2 years or so, from end of July 20 till end of August now. Category-wise, liquid funds have given about 3.5% annualized. It is the regular plan, the distributor plan. Banking PSU funds have given 3.71% annualized. Corporate bond funds have given 3.8% annualized. Dynamic bond funds lower at around 3.44%, and gilt funds the lowest 2.52%, because gilt funds have a longer portfolio maturity and longer variability. Now, to put it simply, these numbers, 3.5 or 2.5%, are lower than bank deposits. So obviously, investors are not happy, and that has been a drag on debt funds. And the third aspect is the portfolio quality. Now, if you look at the broad allocation to AAA, AA, single A, 2 years ago in July 20 and now, I don't have the numbers offhand, but yes, broadly, the portfolio quality has improved. And yes, to elaborate a bit further, why have returns been muted? So over the last 2 years or so, yield levels have been moving up. And why has that happened? RBI rate hikes, that has commenced now, that is May of this year. But the market works in anticipation. So over the last 2 years or so, in anticipation of RBI rate hikes, yield levels have been moving up. So that has happened. That has impacted bond fund returns, impacted adversely. But at the end of the day, the portfolio YTMs have improved.
Okay. So, Joydeep, what's keeping a lid on returns, and how long do you expect that returns might remain muted?
Yeah, so this is the juncture. Things will improve now. Now, why do I say so? So what has been happening over the last 2 years or so is that while YTMs have been moving up, the adverse mark-to-market has been a drag, as yields have been moving up. But as of now, it is almost already in the price. So RBI has hiked rates by 1.4% since May of this year, and RBI will hike more, maybe 50, 60, 70 basis points more. But it is almost in the price, which means from now on, yield levels will not react much, which means from now on, it will be a more or less steady state kind of returns based on the YTM or the net accrual level of the fund. So things will improve now. Let me give you some numbers as to how much the YTMs have improved. Comparing with July of 2020 and July of this year, we will look at the uptake, as in how much yields have improved over this time period. So as a basket average, liquid fund net YTM, as in the regular plan, net of expenses YTM, The liquid fund category average has improved by 2.21% from 3.18 to 5.39%. Now that's huge in debt. In banking PSU category, it has ticked up by 1.35% from 4.6 to 5.96%. Corporate bond funds, it has ticked up by 1.31% from 4.79 to 6.1%. Dynamic bond funds, a little muted, 58 basis point or 0.58% from 4.78 to 5.36%. Gilt funds, somewhat in between, 76 basis from 4.59 to 5.35%. So what it means is, now that the market has stabilized, whatever net YTMs we discussed, net of expenses YTM, investors would get somewhere around these kind of numbers as the returns going forward. So that is the thing, and that is why we discussed that this is the junction. Now things are turning around.
So therefore, it will make sense that now would be a good time to invest again in debt funds.
Yes, yes. The simple message is you can afford to ignore the last 2 years numbers, which we just discussed. Look forward, and for existing money, just be invested. Things will improve now. And for fresh money, yes, things will improve now. And with these kind of numbers in mind, or to put it differently, if you compare with a bank deposit rate, if you compare with a good quality bank like a SBI kind of bank, these numbers are competitive, even better than bank deposit rates. And if you can hold for 3 years along with taxation indexation benefit, these numbers will outperform bank deposit rates. So that is the logic, and you can invest fresh money in debt funds now.
Okay. So, Joydeep, what is the downside or what is the risk to this view?
Yeah, that is important. The risk to the view is in case there is some more volatility. Now, what does that mean, or how or why that can happen? Maybe say inflation. If there is some more negative surprise on inflation, crude oil price going up, some more geopolitical tension apart from Russia, Ukraine, if there is some China-Taiwan kind of thing, these things can happen. But on the positive side, also things may happen. So as an example, there's a buzz going around about this bond index inclusion. So if that happens, if India is included in one of those JP Morgan index or those Bloomberg Barclays index, that will be a positive for our markets. FPIs will invest in debt, FPIs who follow these indices. So about $30-40 billion of funds may come in over a period of time. That will be a positive. So net, anything can happen. Market can be volatile for some more time. But the message is, at the end of the day, even if the market is volatile, even if yields move up a bit from now on, it will be there in the YTM. And the YTM does not go anywhere. It remains in the fund. Maybe a few more months of volatility, and things will improve now.
Okay. Joydeep, let me ask you, or let me press you a little bit more on this YTM, the yield to maturity data that you provided. What does this mean for a retail investor?
Yeah, this is important to appreciate what it means. So what is, first of all, YTM? The yield to maturity. So there are various instruments in the portfolio like bonds and other instruments in the bond portfolio. So yield to maturity means if you buy the bond at the price which is there today, and if you hold till maturity, what is the annualized return you will get? So in a debt fund portfolio, in a bond fund portfolio, there are multiple various instruments. So as on a given date, given the market level, the market interest rate of the various instruments, the weighted average of all the instruments in the portfolio. So what it means is, as a snapshot, taking into account all the instruments in the portfolio, if it is held till maturity, you can expect somewhere around that. And the metric which people use is YTM minus expense. Like we discussed, let's say a liquid fund, if the net YTM is say 5.39%, it means whatever the YTM is in that category, net of the regular plan expenses, 5.39 is the number net as of now. Now let's look at the other aspect. This I gave you the investor's aspect. The other perspective is from the fund manager. Now, when I talk about fund manager, he or she will never agree to this. The reason is the worlds are different. We as investors advocate how much can we get, what will be the return and all that. For the fund manager, the world is different. The fund manager has to navigate dynamic world. Yields can change every day, and yields do change every day. So if you talk to a fund manager, he or she cannot commit that if you come to my fund now, and if you are there for a horizon, I will give you those kind of returns. But yes, as a ballpark, data has shown over the last quite a few years that if you are there for adequate horizon, you will get that. To give an example, if there's a corporate bond fund with a YTM of say 6% net of expenses, and the portfolio maturity is say 3 years. So if you come in the fund today, and if you're there for 3 years, you can expect somewhere around 6% as a ballpark return, maybe a little bit here and there, 6.1, 6.2, 5.9, maybe a little bit here and there. But data has proven that most times, 80-90% of the times, you get the net YTM as return, provided you are there for an adequate horizon. So that is what is the meaning of YTM, not a commitment, but yes, that is the nearest proxy or gauge as to how much you can expect from that fund.
Okay, we're going to take a very quick break and we're going to be right back. Joydeep continues to stay on with us. There are more questions on debt funds, what are the kind of funds you should look at investing in now? And all of those questions are lined up next. Stay tuned. Hi, welcome back. We're in conversation with Joydeep Sen, who's a corporate trainer and author, and we're talking about what's going on with debt funds and should they once again find a place in investors' portfolios. So we have spoken a little bit about, what's keeping a lid on returns, what is the outlook, and the call now is that this is perhaps a good time to once again be relooking at debt funds. So Joydeep, what else should investors be aware of if they are to look at adding debt funds back in their portfolios?
Yeah. So as you said, once again, I would say it is always, not just once again. So markets do go through cycles like equity markets. Up-down cycles are always there, and same is the case with debt. Now coming to your question, what should investors look at? So I will talk of two things. One is the horizon and the other is the avoidance of recency bias. Talking of horizon, in debt funds, there is a beautiful graded structure. So there is a definition from SEBI on fund categories that there are these 16 defined open-ended debt funds, and funds in this category can do this, and these are the boundaries. Now, all the way, starting with, say, liquid funds at the shorter end, all the way to GSEC or gilt funds at the longer end, there's a graded structure, like portfolio maturity is defined. Liquid funds, portfolio maturity up to 3 months, then ultra short up to 6 months, low duration up to 1 year, money market up to 1 year, and so on and so forth. We have short duration funds up to 3 years and all that. So what the investor can do is measure the cash flow horizon and match the cash flow requirements with the portfolio maturity of the fund. So as an example, if there is a banking PSU fund or a corporate bond fund or a short duration fund with a portfolio maturity of say 3 years, the investors can come into the fund with a horizon of say 3 years or close to 3 years, maybe say 2 years or so, and remain invested for the adequate time period. To give you another perspective for conservative investors, TMF, that is Target Maturity Fund, that's a very good, easy to understand product. There is a defined maturity date. So on that date, the fund will mature and the money will flow back to investors. Whereas in an usual fund, whatever be the portfolio maturity remains and the fund goes on forever. In an FMP or target maturity fund, the fund matures and the money flows back to the investor. So in the usual open-ended fund variety, like banking PSU, corporate debt, short duration, dynamic bond, gilt, as a ballpark guidance, try to match your cash flow horizon with the portfolio maturity of the fund. That is important to keep in mind. Also look at the fund category, the fund strategy set by the AMC, what they want to do with the fund, what is the positioning of the fund, what is the portfolio credit quality, and all these aspects you can look at. You can download the fact sheet from the website. It is very easy nowadays, and just take a look and look at the literature and what all the fund can do. Second point I said is avoid recency bias. So I would say forget the last 2 years numbers. That has happened. That is history now. YTMs have improved and markets are more stable now. And that is the recommendation going forward.
Okay, and by mapping your investment horizon to the funds, you'll be able to benefit from the full strategy of that fund manager, right? So you won't be exiting before you have received the full benefit. But Joydeep, what is the meaning of taking duration calls, in a portfolio? Do you recommend that even somebody like a retail investor could look at this strategy at this juncture?
Yeah, I'll take 1 minute before that on the previous discussion. As you said, the horizon is important. To give an example, let us say there is a corporate bond fund with a debt quantum of say 6%. So what it means is per year, per 100 rupees, the fund accrues rupees 6. So if you are there for 3 years, you accrue rupees 18, 6 into 3, 18 plus compounding impact. So what that means is over these 3 years, even if the market is volatile, you have the cushion for these 3 years of accrual, and that makes your returns stable. The other thing is, over an adequate time period, the market goes through cycles. Interest rates go up, interest rates come down, all these things happen, and the things even out. And that is the relevance, that is the significance of investment horizon. Now coming to your question about duration. So firstly, what is duration? There is a metric called modified duration. It means it is the multiplier. Whatever is happening in the market, yield levels going up, coming down, what is the corresponding impact on the price of the bond and the impact on the NAV of the debt fund. So longer the portfolio maturity, longer the modified duration, higher is the volatility of the fund. So gilt funds have the longest maturity, longest modified duration, and liquid fund overnight funds have the shortest maturity, shortest duration. Now, taking a duration call means if you expect interest rates to come down, you buy into a long maturity fund, long bond fund, and if interest rates do come down, you do benefit from that. Now, at this juncture, I would say broadly no. The reason is, even though we discussed, it is mostly in the price, RBI will hike rates, but it is priced in and all that. We are in the middle of a rate hike cycle. So I would say little more time, maybe say December this year or maybe February next year. By then, RBI should have been done with their rate hikes. So one can take a staggered approach, the SIP approach, start buying your intended fund now, starting from now till December or February. Then we'll get more clarity as to what is happening on yield levels. And to give you a different perspective, some people are conservative. Conservative meaning, people are thinking that RBI is hiking rates, why take a view and all that, remain parked in liquid funds. I would say don't be so conservative. Come into an intended fund, like whatever it is, dynamic bond fund, short duration fund, banking PCO, corporate debt, gilt fund. As long as you have an adequate horizon, you come into an intended fund and you can just be invested, and that's all. Don't take a duration call right now. Wait for some more time, maybe 6 months, 1 year down the line. If inflation eases, if the interest rate cycle turns around, RBI may look at cutting rates, maybe 1 year, 2 years down the line, and then you can take a duration trading call as such. Otherwise, you can start investing now.
Okay, the other thing that I want to ask you, Joydeep, is, we have come out of quite a few credit incidents which have taken place, right? Defaults have taken place, and naturally, investors are a little bit worried on that front. So what is the view now on, has credit risk receded? Are the default risk behind us?
Yeah, this is very relevant. So I'll talk of two things here. One is, if we look at the background, all the defaults that happened, starting with ILFS in September 18, all the way to March 2020, one bank, 81 bond written off, then April 20, liquidity issues and all those things have happened, and the experience has not been good. But if you look at it now, things have improved significantly. Corporates have deleveraged. They have done a very good job by reducing their debt levels. If you look at the upgrade downgrade ratios, like rating agencies have this upgrade downgrade ratio, which gives the ratio of upgrade downgrades, that has improved significantly. And there is no major default after March 20, apart from a few cases here and there. So the background has improved significantly. Portfolio quality also has improved over the last 2 years or so in terms of allocation to AAA, AA, single A, all these things have happened. So if you want to take a call, you can. But the counter argument is, in the portfolio, if we have equity, so allocation is always relevant, so much to equity, so much to debt, so much to gold, and so on. So as long as you have equity in the portfolio, the alpha comes from there, alpha as in the higher returns. So in the fixed income space, yes, you can compare the net YTM of credit risk funds and net YTM of the other, say, corporate bond or banking PSU fund, and you can take your call. And in the trying times also, there have been a few funds, a few AMCs which have escaped unscathed, in the sense that no defaults in their portfolio. You can look at those AMCs also. Or if you're doing an allocation, investing in equity funds, yes, then equity will give you the higher alpha.
Okay. So Joydeep, net, what is your recommendation for investors?
So depending on the horizon, so 3 years is required for tax efficiency indexation. So for 3-year horizon, you can come into a target maturity of fund of say a 3-year, 4-year maturity. You can come into a banking PSU fund or corporate bond fund of say 3-4-year portfolio maturity, come into a short duration fund. If you have a longer horizon, say 5 years, 10 years, come into a gilt fund. If you have a shorter horizon, like say 1 year or so, or less than 1 year, come into money market fund, low duration fund, ultra short term fund. You can match your horizon. Forget the last 2 years, that is history now, and things will improve. And do a staggered approach, SIP kind of approach. Now, mind you, SIP is not for equities only. It is for debt also. So take a SIP kind of staggered approach with the intended horizon, and you should get decent risk-adjusted returns.
All right, Joydeep, thanks very much for joining in. In the last 2 years, nobody has wanted to touch debt funds. But like you said, that the outlook looks to be a little bit more promising. Things are on the mend, and it is no time to not be having a debt exposure. In any case, it should be mapped to your goals and to your asset allocation. Joydeep, thanks once again for joining in and for explaining the broad trends in the fixed income space. With that, we'll wind up on MF Corner. Do remember to keep sending us your queries, and we'll take them up with our experts through the week. Thanks very much for watching. Do stay tuned to CNBC TV 18.